Okay, guys, so I did just end the webinar and then having everybody log back in here. So sorry about that. Yeah, and then I'm going to make Tracy again a panelist. So at least she's there as a panelist. And then we're just going to go ahead and start boogieing forward here as soon as we get everybody back on. So sorry about that. Hey, you're there now. You're on mute though. You're muted.
I know. Okay. Oh my gosh. Okay. So here I am. Now go for it. And I've got people texting me, so I've got to get them on.
So don't worry, guys. We'll get done by 11. So even though we had some technical difficulties there at the beginning, we will get done by 11. So that way we can get everything done in time for you guys, because we know that time's of the essence. Okay. So let me run through. We are recording this and we'll send this out to everybody as well. So that way you'll have the recording, the beginning. We've got almost everybody back on, Tracy, just to let you know. Okay, as we go forward here, so the program, Advanced Lending Strategies, how to help financing to help buyers and sellers. Really, when we're looking at advanced strategies, this is something that really a lot of people aren't going to talk about. And I'll tell you why. And right now, a lot of lenders are so they're so focused on the refinances and that they don't have a lot of time to be able to look at different strategies with clients. We really feel that education is the most important, and we want to make sure that when we're sharing information with clients, it doesn't matter if it's a purchase or a refinance, we're always looking at strategies that will help that client most. So right now we're on advanced strategies. We also have another class that's called Advanced Strategies 2.0, and that 2.0 class talks about mortgage insurance and whether, if you're putting 10% down, do you have mortgage insurance? Do you buy out the mortgage insurance? What are the options? So we'll talk more about Advanced Strategies 2.0 during that class. But today, what we're going to talk about, really, anytime that you're talking a mortgage strategy, you're dealing with the term suitability. And suitability is really more of an investment term, but suitability is a requirement to determine if a particular strategy is appropriate or suitable for a given client based on the client's goals and financial situation. So for instance, one thing we will talk about today is whether cash is the best way to purchase a house. So let's just say that you've got a 30-year-old person that just recently inherited a large sum of money, $400,000. Mom passed away and willed her estate, which was worth $400,000, to the son. The son then now has $400,000. And so suitability comes into play with that, where does the son have the ability to save money? Has he proven in the past that he can save money? What would be the best to do with that money? Would it be best to buy 1, 2, 3, 4 investment properties and an owner occupied? What would it be? Would it be best for him to maybe purchase one house, pay complete cash for that house? Suitability comes into play with what are his habits? You have two different types of people. You have spenders and you have savers. At the end of the day, that's really the two types of individuals that we're working with on a consistent basis, spenders and savers. So if you have a spender, well, then I'm going to say you buy one property, put all the cash that he has into that property, and it's done. So he doesn't have the opportunity to be able to spend that money over time. You have savers. And so if an individual can save, well, at that point, maybe, taking $100,000, putting into maybe some investments with a financial planner, taking a couple $100,000, buy a couple properties, maybe 2 or 3 properties, and then have another $100,000 left over for reserves, or $50,000 left over for reserves for his rentals. So we can create really a long-term strategy and a plan, but it really goes to suitability. What is the best for that client? And we will talk more about suitability as we go forward with reverse mortgage, because that is a definite area there for suitability. So again, today we're going to talk seller buy down strategies, reverse mortgages, and then cash. Really, what is a seller buy down strategy? And this is really an out of the box strategy that is employed to help buyers, help bring buyers to your listings. Simply stated, instead of lowering the price of the house, you market the house with seller concessions. This is done with both buyer's agents and listing agents. So why would I bring up seller buy down strategies in a hot market? Well, the reasoning behind that is when we last researched this, there were over, it was over 100, might have been over 150 houses over the last couple of weeks that had been decreased in purchase price. And so the purchase price had been decreased, whether it's $5,000, $10,000, whatever, the house hadn't sold. We still have houses that are out on the market that aren't selling within 2 hours. So, and with that, the typical way that that we go forward if a house doesn't sell is we lower the price of the house, right? So if it's not selling, we immediately go to that strategy of lowering the price of the house. Now, the reality is that as we employ that strategy really doesn't help a buyer out that much at all. So let me go and let me bring up my total cost analysis on this to actually show you some meat and potatoes behind that. So Tracy, we should see total cost analysis, seller buy down strategy, right? Thumbs up?
Yeah.
Perfect, thanks. So here's the seller buy down strategy on a $350,000 listing. Now we take that $350,000, we, and the reason why I say this is a buyer strategy and a seller strategy is I'm going to talk about both right now. But let's just say that, you lowered the price of the house by $10,000. Whether it's through a lowball offer that you got, or whether it's through, the house hasn't sold, so you lower the price by $10,000. Either way, ultimately the purchase price goes from $350 down to $340. And so with that, I want to share with you guys really the practical aspect of lowering the price of the house by $10,000. And that would be, the practical aspect is that saves the buyer about $46 a month. $46 a month doesn't really sway anybody one way or the other. Now, a listing agent might say that, I've got, buyers are looking at $350. So therefore, if we lower the price of the house by $10,000, at that point, the house is $340. So we've got buyers that are looking in that $340 range. I agree with you. But the point that I want to bring forth to you is this. It doesn't matter if a buyer is making an offer on the house $10,000 lower, or whether the seller has lowered the price of the house by $10,000. It saved the buyer $46 a month. So there's a different way of thinking about this, and maybe a different way of marketing this, where now you can help a buyer that might be looking at a $300,000 house, hypothetically, or $290,000 house, hypothetically, buy that house that could be $350. And let me explain. So the next section would be on a seller buy down strategy is seller incentive financing. So you market the house that this property has special seller incentive financing. Still the same aspect, still the same thing. We're going to end up, the seller is still going to give a contribution, and that contribution on this transaction was $10,000. So that still happens, but ultimately we were able to take the house that would be, we still marketed at $350,000. We have seller incentive financing. Maybe we post what a payment would be. A payment would be something in the ballpark of $1,779. There's some tricks to marketing that I can help you guys with, where we can create a total cost analysis on the house, just like what you're seeing now, that you can put in your remarks. So that way you're not quoting rates and fees and everything, and now you need a bunch of disclosures. We already have them all in the total cost analysis. But ultimately, you can market it in such a way and say something to the effect of, and you guys know your rules better than I do, but something to the effect of seller incentive financing. This house, your payment could be somewhere in the ballpark of $1,779. And the seller is willing to buy down your interest rate, help buy down your interest rate, or buy out your mortgage insurance premium, whatever it is. The point that I want to bring home to you is this. By having the seller contribute $10,000, and this was just a fictitious transaction where interest rate was 3.5%, that $10,000 took the interest rate down to 2.875%. That saves the buyer $260 a month. Now that does two things. One, that helps that buyer that would be looking around the $300,000 range afford a house at $350,000. So now buyers start to look at that a little bit differently, instead of just looking at just a $300,000 house. But also it opens up the market a lot more to individuals that are looking at a lesser value house. And it helps you to be able to market it in such a way to where now you have the comparable sales that come through at $350,000, not at $340,000. The seller's still doing $10,000. They've still lowered, in essence, what they're getting by $10,000. But what I want to drive home on this is that instead of just lowering the price of the house and saving the buyer $46 a month, you market it differently. The seller still contributes that $10,000, but yet you save the buyer $260 a month. So maybe the seller incentive financing says this house qualifies for special seller incentive financing that can save you $260 a month on your monthly payment, maybe something like that. And then we include a total cost analysis in there to be able to see, what the specifics of that is. So the reality is that be able to hit that same type of payment of $1,779. And so we have a buyer that's looking somewhere in the ballpark of $1,800 a month on their monthly payment. Your house is outside of that market at $350,000. If we do seller incentive financing and we talk about what the payment could be, what the savings could be, that would be equal to them buying a house at roughly $290,000. So what I want to drive home with that is that $294 would be the purchase price at a $1,777 a month payment, where now we can qualify for your house at $350,000 at $1,779. This also works in the aspect of you get a low ball offer that comes in and you're the listing agent. You've got a buyer that knocks the price down by $10,000. At that point, you guys can accept the contract or give us a call. We can create a total cost analysis that we can send to you, that you can send to the buyer's agent and whatnot. Maybe instead of, because again, what they'll see is the savings of $46 a month. Maybe you guys can be the hero to your seller and say, hey, instead of us lowering the price of the house by $10,000, let's maybe give the buyer $5,000 to then buy down the rate or buy out the mortgage insurance premium and save, instead of $260, you're saving $130 a month, to where now your seller gets $345,000 $345,000 instead of $350,000. So they've lowered it by that $5,000, but they didn't have to take that whole $10,000 hit. So I hope that that's coming through clear. Point being, there's different ways of thinking about financing. And I think a lot of times we get stuck into a rut of doing one thing. That one thing isn't helping out our buyers or our sellers a great deal. there's a different path that we can follow, maybe a little bit different way of looking at financing, how financing can help you sell houses, and look at it a little bit differently. So that's really all that we wanted to share with that. Because it is, right now it's really for those houses that haven't sold for the last month or whatever, and you're looking at a price concession. Instead of doing that price concession, just give us a call. We'll do a total cost analysis for you to show you options that you can show your seller. And it might be just, having the seller, offer $4,000 in concession or $5,000 in concession instead of 10. But again, we can show where that would be better. And then again, the big thing is, instead of just accepting a lowball offer on a house, which I don't think there are many lowball offers on houses these days, but every once in a while, I think you'll get one. Instead of just accepting that, give us a call. Let's work some numbers up and see what we can do so you can be the hero, following seller incentive financing, following a seller buy down strategy. You can be the hero to your seller. So let me see here. I've got a couple. Kind of get your full name for the CE. Let's see. Okay, those are yours.
Yeah, I'm running through the list of attendees, and there's a lot of just first names, and I don't know who people are. So you need to make sure that your full name is on your device in order to get your credit hour.
And I'll get that list as well for you afterwards, because they've had to register coming in.
Okay, great.
Okay, so as we talk about seller buy now strategies, I think I kind of hit that hard there. And if you guys have any questions or any thoughts, just give us a call, or put them in the comment section. Happy to answer them there in the comment section. Again, really the seller buy down strategy is for buyers agents and listing agents. It is a way that the listing agent can be a hero to their seller, and not accept that big deduction, but maybe a smaller deduction, help offset the payment, and we can help create some strategies around that. And so it's just really educating buyers and sellers. The other thing is a lot of buyers really, they don't understand that lowering the price of the house by $10,000 affects their payment by, it could be as much as $60 a month. But again, with $60 a month in the grand scheme of things, that doesn't make a huge impact upon a lot of buyers these days, we're finding. So as we head into reverse mortgage, so really, what is a reverse mortgage? A reverse mortgage is really known of today. Reverse mortgage is kind of the old term. It's really called a HECM mortgage now, and that is a home equity conversion mortgage. It really is an FHA insured, government related or government regulated mortgage. And it provides extra income or cash for homeowners over 62 years of age. I can tell you that my mom has a reverse mortgage. I believe that reverse mortgages are a good financial planning tool for the right individual. Again, this goes back to suitability. And so both reverse mortgage and cash, whether to pay cash for a house, are both really suitability issues. And so on reverse mortgages, there's several things with reverse mortgages. First, the homeowners can convert part of the equity into their home. And so what my mom and my father did before my dad passed away is we did a reverse mortgage for them. They pulled out some equity out of their house, and then they did a lot of home improvements. Pulled around $30,000-$40,000 worth of equity out. They did a lot of home improvements on the house. We're finding that a lot of seniors, the house over a period of time needs a lot of improvements. And so because they're not able to do those. Big thing is that there's no monthly payment on a reverse mortgage. The money the homeowners receive is not taxed as well. So this can be a big thing for if you've got grandparents that maybe they want to help out either their kids or their grandkids. Maybe they want to pay for their college education. Maybe they want to give them part of their inheritance now to help them buy a house. Maybe they want to give them part of their inheritance now to help them help their kids or grandkids invest in a business, or just go on vacation, whatever they want to do. The tool is there to be able to do that through this. The money is not taxed because it's all in their mortgage. It's all in their house. And so homeowners choose how they want to receive their money, whether it's a lump sum or monthly, on a monthly basis. So their house could start paying them on a monthly basis, and it keeps homeowners in their home for long term. So for instance, my father passed away in 2009. When my father passed away, his pension went away, and my mom got his Social Security, but my mom's Social Security went away. So my mom went from about $4,000 a month in income to it was about $1,300 a month in income at that time. So with her, if she had a mortgage on the house, there's no way that she would have been able to live there. She would have had to move out. And so with that, the reverse mortgage has helped her be able to stay in her house as long as she possibly can. She has no payments. The payments just get tacked onto the principal every single month. And it's been a really good financial tool for her. So sell more homes with reverse mortgage. You can gain new customers on a reverse mortgage, increase sales, increase your buyer's purchase power, and really set yourself apart. So as I go through this, there's really a couple things that I want to bring home with reverse mortgages. Reverse mortgages are a great financial planning tool. Excuse me. So for instance, let's say that a client is 63 years of age. They have their house paid off. They want to downsize. And so they don't want the big house anymore. They want a smaller house. Of course, all kids are out of the house at this point. They're starting to have grandkids. They want a single level house. They go from a house that's, it doesn't matter the price, but 2-story house to a 1 single story house. They have an option, of course, of being able to pay cash for that house because their house is paid off. So do they take their money and then go and pay cash for their new house? Or do they take part of the money and instead of paying cash, maybe they put 50% down on their new house, have a reverse mortgage of 50%. They don't have any mortgage payments at that point. And then they're able to take the remainder of that money, maybe purchase an investment property or purchase some other investments or live off of it for a while, let's say 2, 3 years, 4 years, to where then they don't have to pull money off of their investments, off their IRAs or any other investments that they may have. So they can let that money sit in there as long as possible. If you remember the rule of 72 when we were all in school, I've kind of dumbed it down for myself, but made it a little simple. And that is basically your money will grow and double over time, depending upon your interest rate. So we find typically if a person's making about a 5% interest rate, their money is going to grow and double about every 10 years or so. If they're making around a 7% interest rate, their money could grow and double about every 7 years in that ballpark. Now, let me show you a total cost analysis on a reverse mortgage. I'm almost there. There we go. So here's a total cost analysis on a reverse mortgage. And again, this is client has $300,000 cash and they decide to put the cash down on the house. They of course have no interest rate because they put cash down in a house. They're still going to have taxes and insurance on a monthly basis. But ultimately, they don't have a mortgage payment. And so another option would be they do a reverse purchase, which you can do. So again, you buy a house, $300,000. You put $150,000 down on that mortgage. I'm just showing the interest rate at 4.5%. Now, right now, my mom's interest rate is below 2%. It is an adjustable mortgage. HECM mortgages are an adjustable mortgage. And so, so my mom's interest rate's below 2% right now, but I want to show it at 4.5% being ultra conservative. Payments over 360 payments. So that payment becomes $1,216 a month. And again, remember now out of that payment, let me show you here, where that total payment of $1,216 includes $350 a month for the property taxes and insurance. With that, you know, they can, I mean, they can make the payment if they want to on a monthly basis, but really that just can go on to the principal on a monthly basis, to where they still don't have a payment. They would have a payment of taxes and insurance of the $350, but they wouldn't have the payment of the rest. Now they can take their $150,000 and invest that over time. And you've got two different ways to be able to invest that. Of course, you guys being realtors, do you know any good realtors that can help a person buy an investment property? Probably. And so they can purchase an investment property. Again, the same thing, a $300,000 purchase. They put $150,000 down on that investment property. Let's just say again that investment rate is 4.5%. It's much lower than that. They could collect, well, their payment would be $1,103 a month. On that $300,000 purchase, what can you collect for rent? Could that be $1,500, $1,600 a month in rent? $1,700 a month in rent? So that could clearly offset the payment of $1,110 a month, and then give positive cash flow to the purchase, to the reverse purchase, which then could offset the taxes on a monthly basis, to where now that client that purchased a house at $300,000, now they've still got their principal and interest that's getting tacked onto their mortgage every month, but now they can afford to live in this house with no payments, because they're making positive cash flow from their investment to offset their taxes and insurance on the purchase that they just created. So just a little different way of looking at things. You know, the other aspect is that you can take that $150,000, you can invest it with a financial planner. And we work with some great financial planners. So if you invested that at $150,000 at a 5% return, just over a 15-year period of time, that money grows to $317,000. So is that a strategy that they're going to use to help, you know, grow their investment strategies longer over time? Is it an investment strategy that they can use to not pull money from their IRA on a monthly basis over time, to where now they can wait 3, 4, 5 years out there? Is it something that they need to use to where they're going to need money in 15 years from now to be able to live on, to where they can employ it that way? Or is it something that they use to be able to purchase an investment property to set them up for success with an ongoing annuity, in essence, money coming in on a monthly basis from their rental, to where they can offset their taxes on a monthly basis for the purchase that they just created? So the reason why I wanted to share reverse mortgage with you is really an investment. A reverse mortgage can be a good financial planning tool if you use it over time. And again, it's about the suitability for the client and teaming up with the right individuals. Now, the great thing about a reverse mortgage means a lot of times we're going to be teaming up with a financial planner. So you're part of the plan. The financial planner can be part of the plan. Now you can gain a relationship with the financial planner to then be able to potentially work with their clients as well. Because this is truly an out-of-the-box idea. This is not an idea that most loan individuals are going to be sharing with you guys. As we run through here, reverse mortgage. Now, the one that I always find kind of mind-boggling to me is I've watched numbers over the years, and it seems like we have anywhere from, I think the numbers were 2,000 to 2,500 people on on a yearly basis paying cash for a house. And so I understand that when a cash buyer comes to you and says, hey, I'm paying cash for the house, I understand that's a done deal. It's easy. It's like, hey, let's boogie forward. Let's go find your house. As I've talked to the agents that I work with, I've asked them, what do you ask when somebody says, am I paying cash? And they were quite frank with me and blunt with me. And they said, well, I pretty much just asked them, do you want an inspection? Do you want an appraisal? And when do you want to close? So there's really nothing else beyond that. I'd like to challenge that thinking in just a little bit, because I think that we could be shortchanging ourselves, but more importantly, I think that we're shortchanging our client on challenging their thinking. And I always like to challenge thinking. Again, it goes back to suitability. What makes the most sense for clients? Now, as I go to my total cost analysis here, whoops. Cash buyer. So okay, and you guys should be seeing this, right? Cash buyer, total cost analysis, Tracy. Okay, so again, this is just we're just looking at a $300,000 purchase, looking at it in two different ways. So we've got a person paying cash for a house. They spend $300,000. Again, they have a payment of $350 a month. That payment is the taxes and the insurance. Now, of course, a person paying cash doesn't have to have insurance, but I would highly suggest it. But they're going to have to pay their taxes, and they're not going to pay it on a monthly basis, but they do need to budget the money on a monthly basis. So we're showing that the payment at $350 a month just for budgeting purposes. Now, we know that if we buy a house, $300,000, that person had $300,000 cash to buy that house. But let's just say that they put $75,000 down. Their payment's going to be roughly $1,360 a month. And then again, that covers taxes and insurance as well on a monthly basis. Well, let me confirm that. I think it does. So we'll confirm that here in a minute. So they could go that route, and let me go here. So yeah, so the payment, $350,000 or $300,000 purchase price, $225,000 loan. We're looking at a total of $1,360 per month. That's $1,010 on a principal and interest, $300 a month for property taxes, $50 a month for homeowners insurance. So that's $1,360 a month. So that's a path that they can go. Now with that, they've got the remainder of the money here. Let me see what I did. Okay. So with this, what I wanted to show was a value of a house at $300,000 going up at 5% per year. That value of the house, they're going to have a net worth of roughly $1.296 million, which is crazy to think. A value of a house that's $300,000 today at a 5% appreciation rate over 30 years, which we're going to have some years higher than that, some years lower than that, but that's an average, will be worth roughly $1.26 million, $296 million. If they followed an investment strategy, they could have a net worth of roughly $2.1 million or $2.3 million. And I'll explain what those investment strategies are. But ultimately, they can help their investment strategy much more instead of just paying cash. Now, investment payments over time, if they were to take that $1,300 and actually invest $1,360 a month on a monthly basis over 30 years, let me confirm that's what I was looking at here. Yeah, so it was an investment of, oh, I see. What I was doing on this strategy was they paid cash, but ultimately what they did is to map this out. So then that way they paid cash for the house. If they were to get a loan, their loan would be $1,360 a month. If we took out the property taxes and the insurance, the payment would be roughly $1,000 a month. And so instead of paying cash, they did pay cash for the house, but then they took that extra $1,000 a month and invested it over that 30-year period of time. So with that, ultimately, they would create about $840,000 worth of wealth accumulation. So if they followed the strategy of just paying cash for the house and then saying, hey, I'll take that extra payment of $1,000 a month and invest it over time, they're going to net roughly $1,000 or $840,000 of that. What I wanted to show was that the compounding effects of money work differently than just paying on a monthly basis. And so this strategy here was one lump sum, where they took $225,000, invested it at 5%. Over that 30 years, that lump sum grows to $1,005,242 over time. So the best strategy is instead of on a monthly basis investing your money, if you can do one lump sum, so they bought their house but they take one lump sum, $225,000, and invested it. At that point, they're going to walk away with $1 million more than if they were just to pay on a monthly basis, or not $1 million more, but they'll walk away with $160,000 more doing one lump sum than just trying to pay on a monthly basis. So again, really the point on this is that there's different ways of looking at clients paying cash. There's the same way as we're looking at that reverse mortgage. Maybe the client doesn't invest $225,000 in the market at a 5% return, but maybe they invest it on a rental property, one or two rental properties. What does that do for them over time? And so what could be the strategy that we could put in place for them to help them create long-term wealth accumulation, where you have 3 houses going up in value at 5% per year, or 4 houses going up in value, or 2 houses going up in value, and then maybe some money in the stock market and in mutual funds and in annuities and different things. What makes the most sense for the client? And so again, I think that we're shortchanging our clients when we're just saying, oh, you're paying cash for a house, and okay, great, everything's hunky-dory, pay cash for the house. And we're not challenging them a little bit and asking them a few more clarifying questions as to why do they want to pay cash for the house? Is wealth accumulation important to them? And so, if the question is behind why they want to pay cash for the house, that could be just something that, maybe they don't want a payment on a monthly basis. Maybe they want to live part of the time here and part of the time in Arizona. And whether they're snowbirds or not, but they want to do that, and maybe they want to, maybe they just don't want a payment. So with that, an investment strategy really may not work because they're going to have a payment on a monthly basis. But maybe it's something that they just haven't really thought much about it. I had a client in here before our meltdown, before the whole COVID aspect. So I had a client in here, and he was looking at, originally he wanted a $150,000 mortgage. He was selling his house over in Virginia. He came in and he was buying a $455,000, $500,000 house or so, and he wanted a mortgage of $150,000. As we walked through these investment strategies with him, we started to find out what was important to him, and he realized that the mortgage, he was going to keep the mortgage for as long as he possibly could, because it's basically free money. His interest rate is 2.75%. And so with that, it was, as he called it, it was free money. So why not take out more of a loan and invest that money? And that's exactly what he looked at. As he invested that money, what we showed him is that over a period of time, within 9 years, he would have the ability to be able to pay off his mortgage if he wanted to. So he would have enough money as he took that 150, an additional 150, and invested it. He took out a $300,000 loan, took 150 and invested it, took the other 150, purchased the property. That literally in 9 years, he had enough money in that separate side account to where he could physically write a check and pay his mortgage off. Now with his $150,000 route, there was no way that he could do that. He was going to have that mortgage for 30 years. And payment really wasn't as much of a factor for him at this point, but payment becomes a big factor for him at year 15 to 20. So for him, what he wanted was, he wanted a financial strategy and a tool that allowed him options in the future. And for him, the option was, one, if he kept the mortgage all 30 years, he walked away with an extra $1 million, which was it was like $1.2 million, and that. And so just by investing $150,000 today, keeping it over that period of time. And I think for him, we did it at a 7% return or an 8% return, because that's what he's been receiving for quite some time. But the point is that really it's a financial planning tool. A mortgage can be more than just a debt, but it can be a tool to be able to help us accomplish our long-term goals, whatever those may be. And we at the Schultz team, we work really hard on trying to obtain what are our clients' long-term goals, what's going to help them over time, whether it's just get into a house today because they're a first-time home buyer, whether it's a refinance to get rid of mortgage insurance, whether it's a refinance to pull money out to buy an investment property, or invest in a business, whatever those long-term goals are. So I wanted to share those things with you because I think a lot of times we get kind of stuck in our rut, and I know I do. I have blinders on, but I wanted to really give you a lot of out-of-the-box ideas that can help you long-term think about financing a little bit different. And I hope that this class did this today. So are there any questions that we had that we needed to get answered?
I don't see any questions in the chat, but I have a question about reverse mortgage. How old would you be before you would consider doing that?
Well, 62. So 62 is at the age that you can do it. Okay. I've had a client that was 90. She was over 90, and we did a reverse mortgage for her. So this was a situation that the attorney brought the client to us. The client was in a nursing home. She was being taken care of, before going into the nursing home, this put her in the nursing home. But before that, she was being taken care of by her niece. Niece had drug problems, started really just milking grandma for everything that she was worth, really dwindled most of grandma's money at that point. The attorney found out about that, that had been taking care of the estate, that was the executor of the estate, got the niece, out of the picture. Grandma then had to go into a nursing home for a period of time. Grandma hated nursing home, which most people would. Grandma wanted to move back home and to be taken care of at home and pass away in her house. And so, so what we did is we did a reverse mortgage. She was able to pull. The older that you are, the more money you can pull. So at 62, your loan to value is going to be around 50%. For her loan to value was about 70%, if I recall. So she's able to pull more money out. We pulled a bunch of cash out. The attorney then has that cash and was paying her bills on a monthly basis, was giving her some money to be able to live off of on a monthly basis, but also the attorney's paying to have in-home care come in and some other things to where now this lady can be in her house, can be secure in her house, and her financial needs are taken care of until she passes away. So that's another way to be able to look at it as well. But you can do it, as late in life as you want, or at age 62.
Gotcha.
Great question. Any other questions?
Nope. Everyone's quiet today.
Is everybody still on the call?
I know. Yes. I think it was the trauma of getting on this call today for some reason. So sorry about the inconvenience for everybody. And I appreciate your diligence to continue to try to get on there.
Yep.
See what we've got.
So sorry about that. And yeah, we, first time it didn't work for some reason, second time it worked awesome. So, again, Tracy, thank you so much for hosting this, for allowing us to be able to share education. Education really is at the heart of what we do. And these same strategies that we share with you guys, we share with your clients, and we always want to look at different ways and different strategies. One thing I do want to share with you guys real quick. So just a strategy here. I see that nobody's signed off yet. So just a quick strategy. So I'm going to suggest that you guys call your past clients and that you talk to them about whether or not they've had a mortgage review as of late and whether a mortgage review would be important to them. We'd be happy to work with your clients on doing a mortgage review. That's really to see if their mortgage is as efficient as it could be. Let me share with you guys a quick experience that one of my clients had. So we called our client. We reached out to our client last year. We reached out via email and phone, and he didn't respond. And so, I'm sorry, we reached out via email. He didn't respond. I quickly looked at his mortgage and said, okay, there's nothing that we can really do here. So we didn't reach out via phone, and we just kind of let it go. This year, of course, we reached out via email. He doesn't respond. We then call him, and he's like, hey, yeah, I'd like to have a mortgage efficiency checkup. So we said, great, let's do it. So I got on the phone with him at our time, and I started looking through his mortgage, and I said, okay, it looks like we can save you X amount of dollars a month. And he said, well, I refinanced about 3 months ago. I said, oh, okay, you refinanced. What's your new mortgage look like? And he said, well, it was incredible. I hardly had to do anything. And I saved like $200 a month. I said, okay, great. What type of loan did they do? Now, his strategy originally when he bought the house a year and a half ago was to go FHA on the purchase and then convert over into conventional when he could and buy out that mortgage insurance or not have mortgage insurance when he converted over. So we'd be able to get a large savings. Ultimately, he said, and this was the trigger for me, he said, Walt, they made it so easy on me, I hardly had to give them anything. They did some sort of a streamlined refinance for me, which meant that the servicer took them from an FHA mortgage into a new FHA mortgage, which also meant that the servicer just charged them another 1.75% for a funding fee that FHA requires. So I knew that that cost the client just to go FHA an additional $4,500. So I said, well, Steve, I thought we were going to go conventional. I thought that was the strategy. And he said, oh, well, I forgot the strategy. Shoot, I totally forgot we were going to do that. They just made it so easy, and we were able to save $200. It was like, I forget, it was $200 and some odd dollars a month. And I said, well, Steve, our strategy would have saved you $520 a month. So the point being, servicers really don't care. They're not looking at strategies. Because his servicer put him back into another FHA mortgage, because his servicer didn't look at the strategy of what was best for the client, not for them, the servicer, but for the client, it literally cost this client $70,000 over a 5-year period of time. So, which was massive. So for him, that call, he said, Walt, I'm sick. I can't believe I did this. He's a blue collar guy. He makes pallets for a living. Great guy, super hard worker. During part of the call, he said he didn't have to pay a dime for closing costs. I then had him get his closing disclosure. And then he realized that he paid over $10,000 for closing costs. So again, he didn't know and that. So understand that servicers are doing this to your clients right now. And if you love your clients, which I know you do, I would highly suggest it's a great opportunity now to be able to reach out to them, to offer them a mortgage review. We'd be happy to do that for your clients. It's free of charge, and really just look at strategy and what makes the most sense for them. So thanks again. And thanks, Tracy.
You're welcome. And thank you. And awesome. You guys have a really, really great week.
And Merry Christmas.
Yeah. Yeah. It's like around the corner. Oh my gosh.
Right around the corner. We'll see you guys soon.
I'm going to go get some coffee now.
All right.
I don't know
Thanks,
if you saw my Facebook post. I had no coffee this morning in my house.
We'll go get some coffee.
Okay. All right, you guys
We'll
have a
see
great
you.
day. Bye-bye.
Bye-bye.